the U.S. economy is something like 20 times the size today as it was in 1969. So we've been through a period of tremendous economic growth. And that's been reflected in the stock market. The $1,000 invested in the U.S. stock market on the day that the rocket took off for the moon would be worth, I think, $146,000 today. So we've had a very strong market. Now, what has happened over the course of those years is a number of institutional changes. For example, in 1969, trading commissions were fixed on the New York Stock Exchange. That went away in 1975. By the time of the moon landing, the U.S. investment business had become almost entirely, or certainly very largely, professionalized. And what I mean by that is that if you go back 20 years prior to that, for example, or even 10 years prior, the majority of assets were controlled by what I lovingly call undiversified amateurs. And what I mean by undiversified, it sounds pejorative, but I don't mean it that way. What I mean by undiversified amateur is someone who is not in the investment business, so they're an amateur, and they don't have a very diversified portfolio. They may have one or two stocks. Now, if you think through that definition, Bill Gates is an undiversified amateur, for example. So it's not these are not necessarily small investors, but undiversified amateurs were the majority of the action. By the time of the moon landing, or shortly thereafter, that had gone away, and the professional investment management community had become a very important part of the investment landscape. What that meant is that increasingly it was very difficult for any particular professional investor to have a sustainable performance advantage over his competitors. Whereas, I mean, imagine a situation if 20% of the assets are controlled by professionals and 80% are controlled by my undiversified amateurs, theoretically all 20% of the professionals can outperform. Now, typically they wouldn't, but it's theoretically possible. On the other hand, if you flip the percentages so that 80 or 90% of the assets and 80 or 90% of the trading is done by professionals, it's very difficult for the average professional to find a source of outperformance, or we sometimes a source of alpha in the jargon. Very difficult to find that source of outperformance, which means that by the late 60s or early 70s, academic observers and others have begun to notice that the majority of professional investors typically underperformed an unmanaged index like the S&P 500 or some of our competitors. What that meant is that in the early 70s, and this is we're coming now to the conclusion of all what that meant is that in the early 70s, the index business really started. I mean, there were indices beforehand. The Dow Jones Industrial Average goes back to the 1890s, for example, the S&P 500 in its current form to 1957. But index funds didn't exist until shortly after the moon landing. And what led to the growth of that business was the observation that we made earlier, that the average professional investor couldn't reliably outperform an unmanaged index of the market in which he was investing. And therefore, it was, from a performance standpoint, it was advisable for institutions and increasingly for individuals simply to say, I can't identify the minority of managers who are going to be above average. I don't think there's any sustainability to their performance. Therefore, the best course for me is simply to invest in an unmanaged index fund. And that business began in a big way shortly after the moon landing happened. We're at a point now where it's hard to estimate exactly, but our estimate is somewhere between 20 and 25% of the total value of the U.S. stock market is in index vehicles. So it's come a long, long way. To me, one of the growth of indexing is one of the most significant developments in modern economic history. It's tremendously important to the average investor. It's obvious that one of the biggest developments in the last 50 years has been the growth of computing power. I mean, I have in my iPad now, or my iPhone, more computing power than Apollo took to the moon. I mean, literally, which is an amazing thing considering how much theirs cost and how much mine costs. So that has impacted every area of modern life. More generally, I think one cannot underestimate the importance of entrepreneurship. And I say that in the following context. If I look at the top 10 stocks in the S&P 500 in 1969, when the moon landing took place, 2 of them are now out of business. one of them, only one, has survived in more or less its identical form over the year. That's Exxon, which then Standard Oil in New Jersey. Two of them have been reorganized. You see a great, and most of the rest of them are not in the top 10. In fact, with the exception of Exxon, none of them are. If I look at the top 10 today, 5 of them, including the first 4, did not exist in 1969. I mean, Microsoft, Apple, Amazon, Facebook, Google did not exist. Not that I often have occasion to talk to college students or high school students sometimes and just talk about the changes in the business, and I always say, when I was your age, which I know makes me sound very old, but in 1969 these companies didn't exist, and now they are among the biggest in the U.S. stock market, in the world stock market, and so it's to me that is evidence that it's very hard to overestimate the importance of entrepreneurship and the essence of entrepreneurship. And no one in 1969 knew what Microsoft would be, or let alone Facebook or Google. And I would argue that no one today knows what their equivalents will be 50 years from now. But I have a reasonable amount of confidence there will be some. If you think about the way that indexing is likely to evolve, I think it parallels in some respects the way evolution has gone since the beginning. So if we go back to the early 70s, just after the moon landing, when indexing began, the first generation of index funds were based on what I would call broad market indices. Classic example is the S&P 500, designed to represent the U.S. stock market, capitalization weighted. That's where the majority of index assets are in that generation, and I think that's where they'll likely continue to be. A second generation came along maybe in the mid-90s, which I think of as subdivisions or extensions of the first, or subdivisions into sectors, industries, sub-industries, or extensions down the cap scale. So S&P 500 begets mid-cap 400, begets small-cap 600, as an example. Again, typically capitalization weighted. The third generation of index, which is really where we are now, involves what I like to call factor indices, and the more common term is smart beta, which is a term I really dislike, but it's in common usage. I feel like I have to mention it at least once. What factor indices are designed to do is to give the user access to a pattern of returns or to a factor. When I say factor, I mean it in kind of an academic sense of an attribute with which excess returns are associated. So, for example, the S&P 500 Low Volatility Index, it's the 100 least volatile stocks in the S&P 500, designed to go down less when the market's down, go up less when the market's up. It's a defensive strategy index. Now, we could go on for hours about that, but that's what low vol is. Now, we developed this index 8 years ago. I have no pretense in thinking that we invented defensive equity indexing 8 years ago, but what indices like low vol do is let the user have access to a pattern of returns or a factor that formerly he would have had to pay active fees to get. And I like to describe this as the word I like to use, which is actually not quite in the dictionary yet, is indicize. In other words, factor indices let you indicize what active managers formerly charged high fees for investors to get. And if you think about the entire history of indexing in the last 50 years, you can think of it as a history of constant unbundling. And what I mean by that is, think 50 years ago, if I'd wanted to buy a fund that I wanted to access the U.S. stock market. Easy enough to do, plenty of mutual funds that I could have bought. I got the U.S. stock market, and I got the manager's stock selection ability, which could be good or bad. The first generation of index funds let me unbundle stock selection from market exposure. And the second generation similarly in its realm. And where we are with factor indices is that we can now unbundle access to patterns of return that we want, or factors like low volatility, deep undervaluation, momentum, and so forth. We can have access to the factor itself without having to expose ourselves to the risk and expense of an active manager stock selection process. So my suspicion is that the history of indicization for the next 50 years, or the history of the index business for the next 50 years, will be largely a history of a story of indicization, as factor indices increasingly indicize what's now available in active form.